Hello and welcome to the MCQ lecture series. In today's class, I'll be talking about multiple choice questions with respect to Indian financial systems paper 1, which is the economics general paper for SYBA. In this class, I'll be talking about multiple choice questions with respect to chapter 3, which is financial markets in India. So let's get started. The first question is, the features of money market are dash, or alternatively this question can be framed in this fashion: what are the features of money market in India? And the underlying options are multiplicity in interest rates, seasonal stringency of money, availability of credit instruments, all of the above. So if we look at it, all these three things, that is multiplicity in interest rates, then seasonal stringency in money, and availability of different credit instruments, are in a sense features associated with money market in India, and therefore all of the above, option D, is the correct answer to this question. I hope the question is pretty much clear. Let us now move to the next question, which is again talking about money market, and the question is framed in this fashion: which of these are important functions of money market? Important functions of money market, or alternatively they can ask, the functions of money market are dash. And therefore let us look at what are the options. It provides funds, helps in monetary policy, it helps the government, and all of the above. So here these are all in a sense important functions of money market in India, and therefore option D, all of the above, is the correct answer to this question. That means it provides funds as well as it helps the Reserve Bank of India in monetary policy as well as the government in its open market operations per se. So this which is all of the above is the correct answer to this question. I hope the question is pretty much clear. Let us now move to the next question, which is particularly talking about treasury bills or T-bills, and the question is framed in this fashion: what is true with respect to treasury bills in India? Alternatively the question can be what is false, but in this case we are just looking about or we are just going to inquire about what is true with respect to treasury bills or T-bills. So T-bills are short-term instruments of governments. Then they are issued in the form of promissory notes. Then they are also called as zero coupon bonds, and all of the above. So these are all important things, or these are all true with respect to treasury bills. That is, it is a short-term instrument of the government of India. Then it is issued in the form of a promissory note. Thereafter it is also called as zero coupon bonds, and therefore option D, which is all of the above, is the correct answer to this question, which is related to treasury bills or T-bills. I hope this question is pretty much clear. Let us now look at who is issuing zero coupon bonds or treasury bills. So the question is, zero coupon bonds or treasury bills are issued by dash on behalf of the government, because see, it is a short term instrument of the government of India, but government of India is directly not issuing them. It is issued by somebody else on behalf of the government of India, and let us look at who is that entity. So here the first option is Reserve Bank of India. The second option is commercial banks, the third option is cooperative banks, and the last option is none of the above. So here zero coupon bonds or treasury bills are issued by the central bank, that is Reserve Bank of India, on behalf of the government, which is central government obviously, and therefore option A, which is RBI or Reserve Bank of India, is the correct answer to this particular question. I hope the question is pretty much clear. That is, treasury bills, what are the important things or features associated with treasury bills, who is issuing it. Now let us look at what is the maturity of that treasury bill or zero coupon bond. So next question is looking at that, what is the maturity of that treasury bill, and the question is framed in this fashion: the maturity of a treasury bill is dash, or what can be the maturity of a treasury bill? And the underlying options are less than 1 year, obviously it is a short term instrument, less than 10 years, less than 20 years, none of the above. Now when I said what is true with respect to treasury bills, I said that it is a short term instrument. Therefore these two options are obsolete. That means it cannot be for 10 years, it cannot be for 20 years, because it is a long term period, and therefore less than 1 year is the correct answer. That means the maturity of a treasury bill is usually less than a year's time, and therefore option A, less than 1 year, is the correct answer. Now the maturity of a treasury bill is less than 1 year. I hope the idea of treasury bills is pretty much clear with respect to these three questions. That means what is true with respect to a treasury bill, then treasury bill is also known as zero coupon bond, and therefore it is issued by whom, on behalf of whom, and thereafter what is the maturity of treasury bills is pretty much clear. I hope these three questions are pretty much clear. Let us now move to the next question, which is dash. It is a definition sort of a question. Dash is a short-term unsecured promissory note issued by large creditworthy companies with fixed maturity. So you have to pay attention to certain words. It is unsecured, it is a promissory note issued by large creditworthy company, and it is also with respect to fixed period for maturity. And what do you call such an instrument? Whether it is a treasury bill? No, it is not a treasury bill, because treasury bill is issued by the Reserve Bank of India on behalf of the government of India. Commercial paper, industrial agreements, none of the above. So it is commercial paper, which is an unsecured promissory note issued by a creditworthy corporation or company for a fixed maturity period, and therefore option B, which is commercial paper, is the correct answer to this particular question. I hope the question is pretty much clear. Let us now move to the next question, which is again with respect to commercial papers, and the question is in this fashion: what is true with respect to a commercial paper? What is true with respect to a commercial paper? And the underlying options are: maturity is 15 days to 1 year, sold at discount and redeemed at par, it is a short-term fund, and all of the above. So all these three things are true with respect to commercial paper. That means now here the maturity part is getting covered. That means maturity is 15 days to 1 year. It is fixed maturity period is there for commercial papers. So maturity is 15 days to 1 year. Then we have it is sold at discount and redeemed at par, and it is obviously a short-term instrument or fund, and all of the above. Therefore all of the above is the correct answer to this particular question, which was what is true with respect to, or what do you think is true with respect to commercial papers per se. I hope this question is pretty much clear. Let us now move to the 8th question, which is again a definition sort of a question. Dash is a method by which banks borrow from each other. That means there is a transaction which is happening with respect to two banks, two financial institutions, to be able to meet credit requirements or day-to-day credit requirements. Now the trade is happening between two banks. The question is, dash is a method which banks borrow from each other to be able to meet their credit requirements. Whether you call it to be a treasury bill, whether you call it call money or interbank market or commercial paper, or none of the above. So here the correct answer is call money. Call money or interbank market is between banks. That means if at all there is a bank which is in need of funds, it will go to another bank and borrow funds, and therefore that market is called as call money market or interbank market, and therefore option B is the correct answer to this question. I hope this question is pretty much clear. The transaction is happening between two banks. Yeah, I hope this is clear. Let us now move to the next question, which is again associated with call money. Call money is a short-term finance with dash maturity. Now we are looking at the maturity of call money instrument. Yeah, whether it is 1 day to 15 days, whether it is 1 month to 1 year, whether it is 1 year to 5 years, and none of the above. So here clearly I am saying it is a short-term instrument and it is happening between two banks, and therefore it is 1 day to 15 days. So that is the period in which the transaction happens or the trade happens. So I hope this is pretty much clear. The maturity for call money is 1 day to 15 days, and it is happening with respect to two financial institutions, particularly banks. So I hope this question is pretty much clear. Let us now move to the next, which is I am talking about what do you call the interest which is paid on call money, and the question is framed in this fashion: the interest paid on call money or interbank market, call money or interbank market, is called as dash. What do you call the rate of interest which is paid? Whether it is called as simple interest rate, whether it is called as call rate, whether it is called as certified rate, or none of the above. So here there is a specific term which is used for the interest which is paid for call money, and it is called as the call rate, and it is highly volatile in nature. It might vary with respect to days, or within the day with respect to certain hours it might vary. Therefore this is called as the call rate. The rate of interest paid on call money is called as call rate. I hope this question is pretty much clear. Let us now move to the next question, which is again a definition sort of a question. Dash are unsecured negotiable short-term instruments in bearer form issued by commercial banks and development banks. Now you have to make sure you pay attention to certain words or certain things. It is unsecured negotiable short-term instrument which is in bearer form, and it is issued by either a commercial bank or a development institution. And what do you call such an instrument? Whether you call it certificates of deposits, whether you call it call money, whether you call it commercial papers, or none of the above. Now we know that call money is between markets, between banks. Then we know commercial papers are by credit worthy businesses, and therefore certificates of deposits or CDs is the correct answer. Now a certificate of deposit or certificate of deposits are unsecured negotiable short-term instruments in bearer form which are issued by commercial banks or development institutions. So I hope this question is pretty much clear. Very important question. You might get such questions in your exams, so please pay attention to this. So I hope this question is pretty much clear. Yeah, let us now move to the 12th question, which is again a sort of definition. Dash is a bill of exchange. Dash is a bill of exchange used to finance the working capital requirement. That means day-to-day capital requirement of business firms. Here I'm looking at bill of exchange used to finance the working capital requirements of a business firm. Whether you call it to be a certificate of deposit, whether you call it call money, whether you call it commercial bills, or none of the above. Now we know certificate of deposits are issued by commercial banks or development institutions. We also know call money is happening between two banks. Now here the correct answer or the obvious answer here is option C, which is commercial bills. Now commercial bills are bills of exchange which are used to finance the working capital or day-to-day capital requirement of business firms. So please make sure that you read the questions carefully. There's a difference between commercial papers and commercial bills. I hope the difference is pretty much clear. Let us now move to the last question in this segment, which is what is true with respect to commercial bills. Obviously we have seen commercial bills which are issued by business firms for short-term credit requirement, which is working capital requirement, and they are usually bills of exchange. Yeah, they're usually bills of exchange. And let us see what is true with respect to commercial bills. So it is a short-term instrument. Yeah, good enough. It is negotiable. Yeah, because it is a bill of exchange. That means all these negotiable instruments have this feature or you can say this point wherein they are all negotiable. And then self-liquidating instrument. It is a self-liquidating instrument. Therefore, and the last point, which is all of the above, is the option available to us. And therefore, if we look at these three options, that means short-term instrument, negotiability of the instrument, and self-liquidating nature of the instrument, all these three things are true with respect to commercial bills, and therefore option D, which is all of the above, is true with respect to commercial bills. I hope the idea of all these instruments and all these ways in which you are looking at money markets in India is pretty much clear. We have seen, we started with something called as features, then we moved towards functions of money market, then we saw certain instruments which are dealt in money market, which is, we saw treasury bills, we also saw who is issuing treasury bill on behalf of whom. Thereafter we saw something called as commercial papers, which are promissory notes and not bills of exchange, and they are issued by credit worthy firms for a fixed maturity period. Thereafter we move towards something called as what is true with respect to commercial papers, and we saw the maturity, which is 15 days to 1 year, and then discount, they are sold at discount and redeemed at par, and all these characteristics. Thereafter we move towards something called as call money market, which is happening with respect to two banks, and it is also called as interbank market, call money market or interbank market. Then we saw the features or what is true with respect to that, and also the maturity of call money market. Then what do you call the interest which you pay on call money, which is called as call rate. And thereafter we move towards something called as the certificate of deposits issued by commercial banks as well as development institutions, and bills of exchange issued by certain firms or business firms which are in need of money for day-to-day capital requirement, and they are called as commercial bills. And we saw some things which are associated with commercial bills, and we saw whether they are true or not. That means it is a short-term instrument, negotiability, and also the self-liquidating nature of that particular instrument. So I hope these questions are pretty much clear. Please stay tuned for more. Thank you.